Hello, with me today, I'm lucky to have John Meyer, mining analyst at broker SP Angel. Hello, John.
Hi there.
A lot's happened in 2020, to say the least, socially, economically, and politically. The pandemic has had a significant effect on people's health and also their wealth. For you, what have been the big moments in the mining industry in 2020?
Well, the year started off on a slightly positive but slightly shaky start, with a certain amount of with concerns over global growth, and then of course we headed into the pandemic. Really, that started in January, but the market didn't get it till February, and in fact we broke the story on Bloomberg when we told the world that this was becoming a very serious business from a Western manufacturing perspective. Western manufacturers were suddenly running short of critical components because China was locking down in various areas, and they couldn't get hold of critical components like LEDs that go into so many different manufacturing devices. So we then saw a collapse, not just of equities, but commodities and other asset classes. Bond yields rose as stimulus programs came through, as policymakers started to talk about much lower interest rates for longer than anticipated periods. So yeah, so much was driven down by fear of the pandemic and people and investment funds moving to cash, and that of course created started to create the situation that we're in now.
John, are there any lessons you've learned from this very unique set of circumstances? And what lessons can DIY investors interested in the mining sector take from 2020?
Yeah, look, a lot of this looks like a rerun of the global financial crisis that we saw in 2008 when Lehman Brothers went bust, and policymakers reacted by bringing in stimulus programs, and policymakers are following that what they did in 2008 is a bit of a cookie cutter template for what they're doing at the moment. And okay, they rushed into big pronouncements on stimulus programs, and of course things haven't cleared up that quickly through the year. We didn't realize we were going to go into a second lockdown in the UK. We didn't appreciate that how long this virus or pandemic was going to roll on for, and some of the economic disruption that it's still causing. So although we can see our way out of the crisis, policymakers continue to add to the stimulus. We're expecting another 2.9 trillion out of the United States. The numbers keep going up. We just had another 800 billion out of Japan. So our stimulus tally is now running at about 20 trillion US dollars worth of shall we say, bailout money, investment program money, infrastructure fund money. And of course this is now the Chinese started to spend this quite quickly, and the Americans and us Brits and the Europeans are beginning to catch up on that. So we're beginning to see the impact of it. And of course it's important from a commodity perspective, because the more infrastructure you want to build, the more commodities you've got to buy.
So this is the Warren Buffett tactic of buying when others are fearful.
Well, Warren Buffett has for many years had the luxury of buying low and then never having to really sell again, which has worked very well for him. I think what we would advise is, yes, there's been quite a lot of buying low going on. When it comes to junior mining shares, they're still quite low. And of course, because they've been so low for so long, they've got a long way up that they can go. Now, the other big megatrend that we're seeing at the moment is the inexorable rise of electric vehicles and the huge investment going into the gigafactories, mega factories, whatever you want to call them, to feed the transformation of our automotive industries and the vehicles that we drive. And that's not about to stop. And in fact, if anything, this is gathering pace. Look at the market valuations of Tesla and a whole range of related companies underneath that. And I'm not saying that people should be chasing those valuations, because I think they are over the top right now. But what I do see is that even if those valuations pull back, what we're going to see is huge multi-billion dollar, if not trillion dollar investment in those battery factories, in those new automotive plants, and the very many new EV vehicles and models that are going to come out of that. And so investors should be looking to invest in the commodities and raw materials that are related to those materials. If we look at graphite, for example, the world's EV factories are going to require at least 3 times as much graphite as is currently produced in the world. I think this applies to natural flake graphite. And where is it going to come from? We just don't. It's not just in graphite. It's in just about every commodity that we look at.
John, the FTSE 350 mining index has almost doubled since March, and it's not been this high since early 2012. Is it just gold driving the rally or something else? And is it justified? Over exuberance?
Well, gold rose quite rapidly on the fear factor when it looked as if the world was melting down. And it's fair that investors should have some gold exposure in their portfolio. It's a hedge against inflation. It's a hedge against uncertainty. It's a hedge against weakness in the US dollar. And we do think we're going to see more weakness in the US dollar. We think we'll see more strength in the Chinese renminbi, and probably the euro will be a bit soft in between. So we're quite likely to see the US struggling to support the dollar. And I'm not sure they necessarily want to support the US dollar. And it means that commodity prices in dollar terms will do better. It means that that many of the miners will also do better in not necessarily in dollar terms. So this is good from a sterling perspective, I think. The sterling is always caught a bit piggy in the middle here, and I do think that the major miners have reacted quite quickly to benefit from that. Remember that Rio Tinto, BHP, and Anglo American all have a certain amount of exposure to iron ore, and iron ore prices have done incredibly well because China has moved very quickly to build more bridges, more roads, more rail systems, and a lot of that is steel intensive.
So fully justified, the rally then?
Oh, absolutely. The cash flows coming out of Rio's, BHP and Glencore are extraordinary, and if you're looking for dividend yield, those are very strong companies to buy into. And if you think that investors used to buy into Shell or BP for yield, and nobody wants to hold oil anymore from an environmental perspective, with lots of funds just being forced to sell those sorts of stocks, and the miners are actually a much better alternative these days.